What's up, everybody? This is Sunko, the Korean bro, and today is uh 2023, uh June, July, June, July, August, September, October 14th. And let's start reading article, okay? Warren Buffett. Warren Buffett relies on H stock now that Apple is crumbling. Warren Buffett's big time faith in Apple is hurting Berkshire Hathaway now. Good thing he's got some other S&P winners to count on. Hmm. Eight U.S. listed stocks in Buffett's Berkshire's portfolio, including from a firm Charter Communications Financial Market Group. T-Mobile US are up since the S&P 500 hit its high this year on July 31st, says Investors Business Daily analysis of data from S&P Global Market Intelligence and Market Smith. Those gains are welcome as Buffett's favorite stock by far hit skis. Apple, which accounts for 55% of Berkshire Hathaway's U.S. listed stock portfolio, is down 8% since July. The value of Berkshire Hathaway position is down a mind-boggling $14.4 billion in just 2.5 months. What exactly is infrastructure in this context of the cloud? It's in reference to big, powerful computing machines called servers installed in data centers that access via an internet or a private network connection. IDC says another big pivot to cloud infrastructure is underway as many organizations around the world start putting artificial intelligence to work, especially with servers powered by NVIDIA's heavy duty chips. Many organizations don't have the financial firepower to build their own data centers for advanced AI workloads. So tapping a cloud provider, AWS, Microsoft Azure, Alphabet's Google Cloud, Oracle makes more sense. In a separate related report, IDC estimated global spending on cloud services will expand at a blistering average for 19.9% rate every year through 2027, at which point global cloud service spending will be worth $1.35 trillion a year. Apple sells some of the most popular products and services in the tech industry. Investors have gotten used to Apple producing lots of free cash flow. The current valuation gives me pause, especially since Apple's growth may be slowing. I don't think anyone denies that this is a fantastic company. It might be a warrant to see that Apple's revenue has declined on a year-over-year basis in each of the last 3 quarters, but shareholders don't seem concerned. The stock has climbed 38% so far in 2023, a better return than the Nasdaq Composite. Zooming out, Apple's rise is even more impressive. This has benefited Warren Buffett's Berkshire Hathaway tremendously, as the conglomerate's portfolio is heavily concentrated in the tech giant. But it's now a good time for investors to buy shares in the iPhone maker. There are strong arguments to consider before making a decision. Let's take a look at them. The best business ever. The iPhone might be the single most successful product ever invented. More than 16 years after the first model was launched, Apple is still releasing updates to the smartphone, and consumers have shown a propensity to pay steep prices for these upgrades, even though the new features might be limited. Apple has a strong stranglehold on the global smartphone market. While it has just a 21% share of unit volume due to its premium status, the iPhone accounts for a whopping 82% of operating profit in the industry. It's still the key driver for Apple's business, representing 49% of overall revenue in the most recent fiscal quarter. Besides the iPhone, Apple has launched the other popular hardware products like the iPod, MacBook, iPad, AirPods, and Watch. All of these benefits from strong demand, bolstered by Apple's incredible brand presence. On their own, the products aren't that impressive to be clear. What makes Apple arguably the best business ever is how it combines this incredible hardware with its own internally developed software and services. The ecosystem is Apple's secret to success. It drives customer loyalty and stickiness. In recent years, services like Music Play and TV Plus are driving greater usage. In quarter three, services represented 26% of revenue, but 41% of your company gross profit. A top-notch product and services portfolio has resulted in massive financial success. Apple's operating margin has averaged a stellar 27% in the past 5 years, and this company generates so much free cash flow that management has to figure out what to do with it. To its credit, Apple has repurchased a lot of its stock, which boosts earnings per share and pays a dividend for adding to shareholder returns. That's a good setup for investors. Finding a wonderful business that possesses all of the positive characteristics Apple does is only part of the challenge. Um, Investors they need to be critical about the valuation that they're willing to pay for such a great company. Even the best business can be terrible investment if the price is too high. I don't think Apple is any different. Currently trades at a price earnings ratio of about 30. In my opinion, this isn't cheap by any means. It's 50% more expensive than Apple's trailing 10-year average P/E multiple, and the current valuation is astronomically higher than P/E ratio that Buffett paid in early 2016 when he first bought the stock. But isn't it worth paying up for one of the best business in the world? If you're willing to pay such high PE, you need to question where the market beating returns will come from. Quite frankly, it takes a lot to move the needle financially for a company that has the scale that Apple does. And unless a game-changing product is introduced that can drive higher growth, I just don't see huge gains coming from Apple in the years ahead. The current valuation provides no margin of safety, so it might be best for investors to pass on your stocks right now. Where will Amazon be in 3 years? Amazon has improved delivery times and will be opening more same-day fulfillment centers. Has invested in generative AI services to help its AWS segment keep its leading position. Invest in generative AI services to help its AWS segment keep its leading position. Amazon has improved delivery times and will be opening more same-day fulfillment centers. The company is expanding into many new areas that could generate years of growth. It might look a lot different from today. It's not easy to keep up with everything going on at Amazon these days. The company has expanded well beyond its beginnings, and has its fingers in many pies. It looks qualitatively different from the way it did even 3 years ago. And the only thing you can really imagine with confidence 3 years from now is that it will look quite different again. Only thing you can really imagine with confidence 3 years ago. However, you can see some of the directions it's moving. And now that gives clues to where it might be expanding. And based on this, you can make some judgment as to whether it's worth investing in today. e-commerce giant. Okay, the acceleration of e-commerce when the pandemic started made only the slightest dent in Amazon's share of U.S. e-commerce. It stands at 38% with no real competition, and it constantly improves its game, making it exponentially more difficult for any challenger to pose any sort of threat. You know, recently management said that it continues to speed up the delivery, with more than half of orders in that top 60 metro areas being delivered within a day. It has its top 100,000 best-selling products, the same-day delivery centers, speed of delivery, with more than half of orders in the top 60 metro areas being delivered within a day. It has its top 100,000 best-selling products, the same-day delivery centers and major delivery hubs, plus millions more nearby. You can get an order ready in as little as 11 minutes. It's hard to imagine that getting any faster. Management is looking to double its count of same-day delivery hubs. It should be fulfilling more orders at that speed over the next few years. In 3 years, it's likely to be getting even more orders to customers within a day or two. The new regional fulfillment structure is also more cost efficient, which should help Amazon get back to improved profitability. Cloud computing giant Amazon's other major business right now is Amazon Web Services, which is also the leader in cloud computing services, although at the margin not quite as wide as e-commerce. Again, the company is investing in product enhancement to maintain its top position. It has doubled down on generated artificial intelligence, which looks like it's more than the most recent buzzword. Its practical applications are far-reaching, and they could change the way the developers work. In product enhancement to maintain its top position, it has doubled down on generative artificial intelligence, which looks like it's more than the most recent buzzword. Its practical applications are far-reaching, and they could change the way developers work. Amazon is far from the only innovator here. It's padding its competitive advantage with a robust suite of services for its clientele. Release several new features and make it easier and cheaper to run models, as well as new services to all developers who write generative AI applications. This is just the beginning, and as generative AI becomes more powerful, AWS will too. It's competing against similar strong contenders like Microsoft and Alphabet, Google, and all of them. In addition to smaller companies, will benefit long term. Amazon's focus on price gives it an edge even now, and that could help it keep the leading and that could help it keep the lead going forward. Healthcare upstart. Amazon's healthcare business is a tiny fraction of the whole right now. So small that the company doesn't break out its sales. It's officially been in the healthcare business since 2018 when it launched a startup called Heaven with JP Morgan Chase and Berkshire Hathaway, which ended in 2021. It also launched Amazon Care, uh, a similar telehealth service for Seattle employees. In 2019, it ended with the acquisition of One Medical last year. It started Amazon Pharmacy in 2020, and customer count doubled year over year in the same second quarter. These are all fairly new investments for Amazon, but it looks like an area that the company is set on exploring and succeeding in. In 3 years, it could be a major part of Amazon's business. More industries to disrupt. The same innovation machine that created AWS just walked out shopping technology, and the rest of Amazon segments that disrupt the technology are likely to bring about new and improved products and services going forward. These are just a small example of Amazon's many businesses and services, and these will almost certainly grow and get better. Amazon stock has created incredible shareholder wealth over time. It should continue to reward investors for the next 3 years and long after. Okay, it's now 1:08 a.m. in the morning, uh, Saturday, and it's time to go to bed. It's getting too late. Okay, so this is it for today, and I'm gonna see you tomorrow. Okay, bye bye.